and good afternoon. I'm Megan Moore with Legislative Services, and I'll have my co-presenter introduce himself.
Hi, I'm Kurt Swimley. I'm with Legislative Fiscal Division, fiscal analyst for property taxes and for the higher education system.
Today we're doing the first of what we're billing Property Tax Tuesdays. Today is Property Tax Basics, and you can see every Tuesday this month there will be a different property tax topic for you. Kurt and I will be back for some of them, and there will be other presenters as well. So today's topic, Property Tax Basics. This has our contact information available for you, and these slides will be posted after the recording, along with the recording after we present them on the Property Tax Library website, and we can show you where that is later. So to start the discussion about property tax basics, we're going to talk about how property taxes are calculated. The property tax is an ad valorem tax, which means it's based on the value of the property. So we take the market value, multiply it by the tax rate to get the taxable value, and then multiply that by the mill levies divided by 1,000 to get the taxes due. Now, there are a number of entities who have a role in this process. Those are the Department of Revenue, which sets the market value of the property, the legislature, which sets the tax rates in state law. DOR also certifies the taxable value to the taxing jurisdictions within the state. And the mill levies are set by a number of entities, including school districts, cities, counties, special improvement districts, voters, and the legislature. And then finally, the county treasurer bills, collects, and distributes the tax dollars to all the entities to which they are due. So we're going to use this structure to talk about the property tax system today by focusing in on each of these different aspects, beginning with market value. The Montana Constitution requires that the state value property. This is in Article 8, Section 3, and it says that the state shall appraise, assess, and equalize the valuation of all property, which is to be taxed in the manner provided by law. Now, this was a change that went into effect when we adopted the 1972 Constitution, and before that time, property was valued at the county level. In state law, there are a number of provisions related to the property tax. The first one I'm going to mention is what I'm calling methods, and includes a provision on how property is valued. We use the market value for all property except for agricultural and forest property. The state law also covers reappraisal cycles. For a lot of property, we use a 2-year reappraisal cycle that includes residential property, commercial property, and agricultural property. Also, beginning for tax year 2024, certain centrally assessed property is valued every 2 years, and centrally assessed property is property that's valued as a unit because it spans county or city or even state boundaries. Examples of that would be pipelines or telecommunications equipment. And then beginning in 2025, forest property will also be valued on a 2-year reappraisal cycle. Right now, that property is closing out the last of a 6-year reappraisal cycle. And then finally, all other property is valued annually. This includes things like business equipment and industrial property. State law also addresses the approaches to value, and these are used by the Department of Revenue to value property. There are 3 approaches to value. The first is the sales comparison approach, which is used mostly for residential and commercial property. And this uses arm's length sales of similar properties and adjusts the sales based on property characteristics. And the information for this method comes from realty transfer certificates that are prepared upon the sale of property. The next approach is the cost approach. This is used for commercial, industrial, and residential property if there's no sales data for the residential property. And it uses the original cost of the property less depreciation and the information for this approach comes from business records. Finally, we have the income approach, which is used for commercial and industrial property, and a modified version of the income approach is used to value agricultural and forest property based on their productive capacity. This uses income generated from the property divided by the rate of return expected from investment property. And I want to make it clear here that when we talk about the income generated from the property, we're not talking about the income of a business, for example. If there's a grocery store leasing commercial space, the income used for the income approach is the income that the owner of the property gains from renting the property to the grocery business, not the income of the grocer. Finally, the information for the income approach is from income statements and financial markets. One other thing I'll note here is that appraisers sometimes use multiple approaches and weight them in order to value different properties, especially more complex properties. Now we're going to shift gears to talk about the tax rate. The tax rate for a property is determined by its property class. In Montana, we have 16 classes of property, numbers 1 through 18. However, there's no class 6 and no class 11. This table does not show all the classes and rates. However, it shows the classes that have the largest amount of property by value within the state. And I'll just draw your attention to a few things here. Residential property has a tax rate of 1.35%. If there is a residential structure that is valued above $1.5 million, the amount of the residential structure, excluding the land that exceeds $1.5 million, is taxed at the commercial rate of 1.89%. Also, business personal property is exempt for many taxpayers. The first $1 million is exempt from taxation, and then the next amount that's between 1 million and less than 6 million is taxed at 1.5%. And then finally, above 6 million is taxed at 3%. Also, railroad and airline property has a specific rate for 2023. I didn't get the 2024 rate in there, but this tax rate is the lesser of the total taxable value of commercial property divided by the market value of commercial property throughout the state, or 12%. And as you can see, the 3.06% is clearly lower than the 12%. Next, we'll discuss taxable value. As I mentioned, the Department of Revenue certifies taxable values to the taxing jurisdictions within the state. And the taxing jurisdictions span from the state as a whole to include counties, cities, school districts, and also special improvement districts such as fire districts or irrigation districts. And these are due to each taxing jurisdiction by the first Monday in August, and they use this amount to calculate their mill levies based on the dollars of revenue that they need to raise based on their budgets. And these taxable values are available on the Department of Revenue's website at this link. As I said, these slides will be made available so you can access the links. Next, we'll talk about mill levies. And the first order of business is to talk about what a mill is. This is a unit of measuring property taxes owed. And it's the dollars owed per $1,000 of taxable value. Another way to think about that is if you divide your taxable value by $1,000, it will tell you how many dollars you have to pay for each mill levied on your property. And there's an example here for you. We'll take a $400,000 market value residence. Its taxable value after we multiply by 1.35% is $5,400. If we divide that by 1,000, it tells us that the taxable value paid, or the dollars paid per mill, is $5.40. How mill levies are set varies based on the entity. For the state, there are mills set in state law. We have up to 95 mills levied in state law for state equalization of K through 12 education. We also have a 1.5 mill levy for vocational technical education that's levied in the counties that have a vocational technical school. There is also a 6 mil university system levy in state law. This was enacted as a legislative referendum and has been in the past. However, it's in state law, so the legislature can also choose to amend that. At the local level, those entities can levy mills as long as they are authorized to do so in state law. And when we think about local mill levies, they are either permissive, which means they can be levied without a vote of the people, or they're voted, which means they require a vote of the people. And then when you talk about schools, they have mill levies that are sometimes required to be levied, or they have to be levied based on a formula. So I'll talk about that a little bit more here. County and city levies are limited to 1996 levels. However, there is a section of law 1510-420 that allows for an inflationary adjustment and some growth from newly taxable property. And that how those mill levies are set is going to be the topic of the Lunch and Learn next Tuesday at 1 o'clock or at noon. So if you want to learn more about that, come back to that one. The other thing is counties and cities can also levy voted levies to raise more than their limited amount. On the local school district side, schools are funded with federal, state, and local revenue, and the school district levies are driven by formula. The state and local revenue is based on our school funding formula that includes the number of students, the amount of state aid, and the availability of other revenue. And school funding is going to be the topic of the October 15th Lunch and Learn, if you'd like to learn more about that. We also have countywide school levies. These fund school district employee retirement and a portion of pupil transportation. And state formulas determine how much must be expended for these purposes and which revenues, in addition to property taxes, have to be used in order to reduce that property tax levy. Now we'll discuss the taxes themselves. As I said, they are billed by the county treasurer and collected and distributed to each entity that has a tax levy on the tax bill. For most properties, the first half of taxes is due in November 30th of a tax year, and the second half is due in May 31st of the second year, the year after. However, for personal property that's not affixed to real property, we have different due dates. Examples of this are mobile homes or business equipment that isn't fixed to a building or land. So for mobile homes, the payments are actually flipped. The first payment is due in May 31st and the second one in November 30th. So the entire payment is made within the tax year. For other personal property, the taxes are due 30 days from the billing date. And the reason these properties have different due dates is because they are mobile types of property. And if the property gets moved out of the jurisdiction, the tax is much more difficult to collect. So the taxes are due earlier. Also, beginning this year, the legislature authorized an optional alternative payment schedule for primary residences in 2023. And this allows the owner of a primary residence to apply to pay their property taxes in 7 equal payments beginning in November and ending in May, with the payments due at the end of each month. As I said, this does require an application process, and those applications were due by September 30th for this year. We also put together a property tax infographic on the history of the property tax in Montana. I'm not planning to go through that in detail today unless there are questions, but there is a link there if you'd like to look at it on your own time. It includes some history from when the 1972 Constitution was adopted to now, including how tax classes and rates have changed and how the business equipment exemption has changed. Now I'm gonna turn it over to Kurt for the next section.
Thank you, Megan. So we also have some resources posted online. We'll show a link later for that show. We'll dive into some of the data behind property taxes and show some of the graphs and some of the amounts of both assessed value and taxes paid in different areas. But, to start off, we have a total of 2.3 billion property taxes that were paid for the last fiscal year 2024, across the state. So it's a very substantial amount of, funding for both our state and for many of the local jurisdictions within the state as well. How this gets divvied up is a function essentially of the state's formula and the amount of property that go across the state. So as you can see on the left side pie chart will show the total amount of assessed value by tax class. This is the Department of Revenue's estimate of the market value that property across the state would be sold for if it was sold on the open market. On the right side, you can see how many taxes were paid by each class of property. You can see which properties contributed the most to the taxes paid. Overall, residential property pays over half of the property taxes throughout the state. And you can see some of the other shares as well. I think we can go to the next slide. So, as Megan talked about earlier, the taxable value of a properties throughout a jurisdiction determine how much property, um, how much each property will pay and which properties pay the amounts of mill levies and amounts within each jurisdiction. So this just part of the state's formula determines which properties pay the taxes within their jurisdiction and what proportions. We have an example up on the screen of Powell County. Now, Powell County, can see on the left-hand pie chart the overall assessed value by tax class, and you can see that most of the property is assessed value in the jurisdiction is residential. It's about 73% of all the property. However, since the legislature also sets and applies tax rates to different classes of property, and you can see that the tax rate for residential property is only 1.35%, whereas pipelines and electric utilities, for example, is 12%. The actual taxable value within that jurisdiction ends up being, for pipelines and electric, end up having a far larger portion of taxable value than originally assessed, whereas the residential portion of tax value within that county was reduced. So this is kind of how the tax rates actually apply to the properties and how much the properties they're paying. Once we get to the end, the pie chart on the right side will determine what share of overall taxes throughout the county, more or less, are borne by each class of property. So that's how the legislature determines which amounts and which rates to apply to tax classes to end up determining what the taxable values are and the tax assessments ultimately end up being on properties. I think we can probably head to the next one. So one way to think about this a lot of times is asking where taxes go towards. We first ask, who pays and what classes of property pay within a jurisdiction, and then we also look at what taxes actually end up funding. Right here, this shows the total allocations of all property tax collections throughout the state and what they went towards across statewide as well. As you can see, the substantial chunks include some local schools, which make up about 30% of that pie, as well as counties and the statewide proportions, and then cities and towns also contributing very significant amounts as well. One thing I'll note here is the statewide proportion is the 95 mills, and this ultimately ends up being redistributed towards schools as well, based on the state school funding formula, which we'll get into at a later date. But if we count that, one thing to note would be that the statewide portion does ultimately fund local education as well. So all property taxes through the state, the majority go towards schools, counties, city functions, some community college levies, and then this other category, which includes things like fire districts, transportation districts, and other miscellaneous districts that local entities can create and levy taxes on. So this shows some information, and once again, you can also head to a tool later on and look at individual areas and jurisdictions to see a bit more where those get broken out to. I think we can go to the next one. All right. So this is an example of, once again, going to Powell County, how the taxable value by class ends up being determining what the taxes paid end up being. So recall that after we applied the county's or the legislature's tax rates to the assessed values of classes in Powell, we end up with this left pie chart of the taxable value by class for Powell County. Now we have an example of all the mills that are applied throughout this county. As you can see, there are ones that go towards different elementary districts. There's one mill for the city of Deer Lodge. There are some countywide school levies and some countywide levies well as the road fund and the state's collection of property taxes as well. Once you apply each of those mills for the correct jurisdiction and the correct area, as per Megan's formula, you end up with the amount of taxes paid by the taxing unit over on the right side. And you can see, all right, about half of, or about 36% of all the tax collections went to the county, about 20% of all tax collections went to the state, and about 31.9 went to local schools, with cities and towns and countywide education also getting some proportions of those. A thing I'll note with this isn't perfectly accurate. For example, this shows all of the mills total throughout that county, but only properties that are within a certain elementary school district will pay the mills associated with that elementary district. And only properties within the city of Deer Lodge will pay the levies towards the city of Deer Lodge. All properties throughout a county will pay the county-wide levies, though, and as well, every property in the state pays the state levies as well. So those are some that are a bit more universal and applied to more properties than some more specific ones as well. If you want to view other properties, you can head to that link, and this will be posted once the slides get posted as well. But leg.mt.gov/lfd/property tax, and you can browse through some similar examples for different counties and different areas for how these might be applied to hopefully give a sense of what property taxes and mill levies are going towards within different jurisdictions.